Well, it turns out the Federal Reserve might have been panicking as early as July, and why wouldn't they be? With jobs revisions down 818,000 over the last year, it seems all but assured we're getting a rate cut in September. Treasuries also over-leveraged at this point, credit card debt on the rise, and of course, a key market reversal could be just around the corner. In today's video, we talk about all of that along with the opportunities that are still presenting themselves in alternative markets. But more importantly than possibly anything else is the dark pool liquidity that we're starting to see appear in one of the hottest markets. That's right, semiconductors are back in focus. Join us today, guys, as we cover stocks, commodities, and cryptos. There's a lot to get into. Well, welcome back everyone to The Daily Show. My name's Tom, and in today's video, we need to discuss the macro, the data, and more importantly, what's about to happen in markets, because there are several key factors that we need to be looking at from the short, medium, and long-term investment and trading ideas. Let's take a look at the revisions though, because the BLS data, well, it wasn't so true. And we always talk about fake jobs numbers when it comes to the non-farm payrolls. Why is that? Well, we've seen it so many times over the years with huge revisions to the upside and downside. This just happens to be the worst one since 2009, and it may even be worse than we actually thought. Mish over here believing it's actually closer to negative 915,000 jobs in creation. So what's the bottom line? Well, the bottom line that it comes to 68,000 jobs per month taken off the area, and it was pretty much within most people's expectations. As we know, the market already knew that the number would be between 600,000 and 1 million in terms of downward revisions. So just remember, this isn't going to move the market as much as you think. And that's why when we look at data, we need to be aware of what the market's already interpreted versus what the market doesn't know. Remember, the fear of the unknown is often what gets volatility started. We also had the meeting minutes come out, and it noted that there were a couple of interesting things. The summary of the key points basically shows that the vast majority of FOMC participants support the policy of easing in September if the economy evolves as expected. Basically, they expect it to be weakening, particularly the jobs market. All participants agreed to keep the Fed funds rate unchanged in July, although several believed there was a plausible case for a 25 basis point cut due to inflation and, of course, labor market data. Remember, they already knew that the jobs were going to be revised down. So realistically, what they're concerned about right now is the jobs market. And this is what everyone has with their thought process. Are we going for a soft landing or a hard landing? Well, here's a little bit of data that's starting to suggest more layoffs are coming. US number of private housing units under construction is dropping big time. Now, what does that usually mean? Well, it means that residential building and construction employment is also going to start dropping. Now, this means job layoffs are coming. And I noticed one of the things in the comments here over on X was that somebody says here, I'm hiring right now, and almost every applicant is looking because they're not getting enough hours at their current job or they're being laid off. Well, there you go. So it's basically on the ground level, we are starting to see a weakening in the labor force, specifically in construction, and we know how this starts and how it takes time. Now, you might think, well, that means hard landing is coming just like that, and a few weeks later, the market's going to crash. Don't get so hasty. In late cycle investing, you will probably think a hard landing is coming for quite some time, and it's important to look for the signs. That's something we do here on the channel. Are we still bullish on markets? Well, as it turns out, in terms of the medium and even 12-month target, we are still bullish. And one of the reasons is that we haven't seen enough negative signs in the markets. You might think everything's terrible, but take a look here. 50% of signals that are triggered today versus an average of 70% in prior market peaks. It's important to put it all together. So you might want to take a bit of a picture of this one, take a snapshot, and there's some good reads here that will help you to define the possibility of a topping market in the future. Now, inflation-adjusted credit card debt. I see this chart all the time. Everybody's always saying credit card debt's at the highest levels ever. It's at record pace. Everyone's going to go bust and bankrupt. Well, while that's true, we do know that, of course, credit card debt has gone up. There's no doubt people are living on debt, and this is, of course, how economies ultimately do expand. But it's still not quite back inflation-adjusted to where we were before the global financial crisis. And I think this is a very important factor. We still need to see more debt creation in the market. We still need to see more leverage in the market. And one of the things that is helping this market to realistically find so much bullishness is how it's rallying. Fastest 10% rally from a correction low ever. Yeah, let that one sink in. This was a huge rally. And when we get a rally like this, when we have so much strength coming into the market, specifically in the stocks we've been talking about, semiconductors and Nvidia, plus over 30% since we talked about it being at its lows only 2 and a bit weeks ago, that usually means that we're going into a very good 1, 2, 3, and even 12-month period. Now, there can be a little bit of shakiness, even though it's 73% read here. Remember, the next 5 days, the next kind of week and a half will be very interesting to see whether we get a pullback. And it really kind of leans into when we saw 8 days up in a row. 8 days of S&P up, 8 days of NASDAQ up, and 11 consecutive, now I believe 12 consecutive higher lows on the S&P 500 so far. Now, do remember this leads into a very good run over the next month. So during the buyback period, you've really got to be mostly bullish on the markets, but a lot of people are going to be looking for pullbacks. So let's take a look at all of these last 11 consecutive higher low runs. You'll notice a lot of them do continue up, but there are a couple that have little pullbacks after these areas and then of course go back into the rally, or a lot of them kind of have sideways market movement. Now, this is important because when we look at Grant Hawkridge's data, which is very difficult to see here because I know there's quite a lot of points, which is good. A lot of data points is a good thing. 44.6% of the time, the market was up over the next 5 days. Now, if you know anything about your stats, that's not a great read. Basically, anytime you're getting less than a coin flip on the markets, that is actually a net negative, and it's something that you will want to think about. We also have a lot of conjecture going on X at the moment and other social platforms talking about Zweig breadth thrust. We know these are one of the best overall long-term reads for 6 and 12-month investment. The main reading is that we didn't probably go below 0.4 before seeing this massive thrust. So just remember, while Zweig breadth thrusts are really good, it may not have triggered in the traditional sense. It certainly has been a great thrust trigger to show bulls are around, but it might not quite be there. What about August into September? Remember, the back end of September is the weakest period of the year. In terms of that 2-week period is something we need to be looking at. And we've already discussed the idea that the Federal Reserve is probably going to do a rate cut. We know that after the rate cut, usually we see a weakness in the market. That weakness is then reverted if we're not going into a recession over the next 12 months. And that's going to be the important thing. What does the market structure show us? Jackson Hole Symposium is now obviously starting. We also know that on Friday, Jerome Powell will come out and talk. If you're trading any bonds or you're trading any kind of interest rate based things, do remember his speech, even if it can be brief, does tend to move the rates. So let's talk about the US economic growth kind of case, soft landing versus hard landing. I would be interested to see your comments down below. Do you think we're going into a hard landing over the next 12 months or a soft landing narrative that might eventually end in a hard landing? My personal opinion is we will go into a recession, and it's probably not that long away, maybe 12, 18 months, maybe 2 years. But we do need to remember that mortgage rates are currently dropping thanks to interest rate cut expectations. And at this point anyway, it looks like the biggest players there, Wall Street and their economists, are all upgrading the economy in terms of earnings estimates. So this earnings season wasn't bad. It's part of the reason why, of course, we wanted to buy the dip only 2 weeks ago. And at the moment, it looks like they're continuing to increase their estimates. Do remember, where are the estimates going? It's Russell 2000. They're really expecting the smaller cap stocks to come along for the party. Now, there are, of course, some risks in the markets right now. One of the biggest ones has to do with Treasury futures. Take a look at this, 10-year futures equivalent amounts, and the amount of leverage in these is starting to get pretty extreme. Now, there are some concerns here because, of course, a lot of people are betting on rate cuts, and therefore they're starting to leverage up these Treasury positions. Could we be seeing a lot of volatility on the horizon? It's a story to continue to watch. It also takes bulls, ultimately, to create a bull market. Now, how do we usually define a bull? Well, of course, we look at price action, number one, but in terms of sentiment, it's really important to not look at necessarily the amount of bulls or the amount of neutral or the amount of bears. Instead, what we want to be doing is we want to take the bull-bear spread. And of course, if the bull-bear spread remains above 20%, which it is at the moment, 28.1 at the latest reading, That's actually an overall great way of looking at bullish sentiment. It's a great way of thinking about these sentiment indicators. Remember, we've been using spread a lot recently, and we talk about this because when we entered into bull-bear spread going from the above 20 to the below 20, well, look at the price action. Look at the price action. What a great thought process here about a very simple indicator that you can potentially start to put into your charts. Now, we always see this one going around, which is basically talking about one-year government bonds or just talking about them kind of starting to cross over and the fact that we go into a recession. I think it's pretty clear we will go into one of these, but timing will be everything. So, of course, the soft landing narrative is currently there. You know what I'm looking for? I'm looking for not only the soft landing narrative, but one of the things we want to see is that we've fixed the economic system and we've finally cracked the code that, we don't have to have hard landings. We got it done. Once that happens, yeah, I'll be terrified. But at the moment, it's still just soft landing versus hard landing narratives. There's a lot of bears, there's a lot of bulls, and of course, the price action is still ultimately mostly bullish. S&P 500 election years, you'll notice here again, we're tracking on the top end. We're certainly not tracking the negative kind of years. And that is to be, of course, considered when we're taking a real top-down approach to the markets at this point. But the next 3 months are probably going to be the most important. The non-recessionary period, where we usually get a flash crash before the rate cut, then we end up driving higher, or the period where we go into recession and market structure changes. These are the two scenarios that we often find. Now, most people don't look at these scenarios, and even when we do our sector special coming into September, so make sure to look at that, our sector special will actually omit 2 of the global financial crisis meltdowns or bubble meltdowns. Why? Because we're interested in what happens in the soft landing narrative post, of course, the interest rate cut. Because if market structure does start to improve like we think about, and remember the ability for the Federal Reserve to cut 25 basis points or 50 basis points will be the most important factor here. We still could be driving higher before we see this nasty market structure. Now, the bad market structure, well, that's not going to be good. So, of course, what happens over the next 3 months will be important. And we know we need 25 basis points if you want to remain bullish in this market. Because if they're doing 50, there's something we don't quite know about. Here's the data that I guess is going around. I posted this over on X, but you'll notice here that things like utilities, things like healthcare don't tend to do well post the cut. Now, that's because they're very skewed towards crash style periods in this data. And therefore, you're not going to get a recovery in the defensive markets where you're actually going, remember, by the time we get these cuts, often you're already deep into a recession because the Federal Reserve is completely panicking. There's a difference between a cut into trying to get a soft landing and a cut because, oh, wow, we have a massive blow up in the debt market starting to occur. Here's a great one for gold bulls. We do love gold here on the channel. Of course, we've been calling for $3,000 an ounce for ages now. And if you actually overlay other gold bull runs, we're well on the way. So, will we get to a 7,200 gold? I don't know about that. But of course, we've been going for 3,000 for quite some time, and possibly even 3,500. If we're talking about following a similar track, guess what? Gold could be $3,000 by April of 2025. Is that possible? Yeah, it's very possible. And at the moment, gold is being purchased, of course, by central banks. Most importantly, central banks, China and Russia, they want to create the major currency of the world, and they're trying to do it by backing it against gold. So do remember that's one of the big reasons. There are several others as well out there. When we talk about S&P 500 performance, Wayne Whaley's got some great data here, and his one tends to line up with maybe a rate cut in September, a little bit of weakness. September 23rd to October 2nd, when we have a similar style scenario, seems to be where the biggest weakness comes through. Great data here from Wayne. I suggest you give him a follow over on X. Good guy. Let's move over to Thursday. Baidu's probably the biggest, and TD, so these are expected options moves. But let's talk dark pool liquidity for a moment, because yes, we saw a sneaky big trader come in with a little short, well, you'd have to assume it's a little short, on semiconductors. Now, does this mean that the market's going to instantly short off? Not necessarily, but if you think about it, a lot of these areas, similar period, ended up in, of course, shorts to semiconductors. I don't expect them to be anywhere that big. You can see they then closed their shorts up here, and the market reversed in a big way. Of course, in this case, it was up. And we just saw another one re-enter. So possibly a shorter coming into the semiconductors for the first time. Another one that was interesting here is someone just traded big time on maybe taking a profit. We don't know yet on the small caps. This is a 3 times leveraged fund. Big dark pool liquidity trade comes through right around where we've seen similar periods. And of course, these ended up being take profits and sells. This one here was, of course, getting that momentum. What is this? Is it a buy? Is it a sell? Time will tell, but certainly at a very, very interesting point. Let's talk rotation. Not really too much to get through on the day. ITB home builders was up, which is, again, a net bullish thing for the markets for the time being. And I wouldn't, of course, be looking at a recession when ITB is doing so well. We talk about it all the time. And the last 5 days, one of our favorites, GDX, doing really nicely. Semiconductors doing amazingly, which keeps a smile on probably a lot of you faces because we were so bullish on it over the last 2-3 weeks. But yeah, I mean, it's an interesting market. I wouldn't say there's anything here that makes me worry too much because, of course, KRE, the broadening of the market, the advanced decline line, obviously overall increasing. These are good signs. But as you may know, some indicators that I do have are starting to give me a little bit of pause. And what that means is we might be going sideways or maybe a little bit of a pullback into longs. Now, why could this be? Well, this stop sign, of course, has a lot of implication. If we take a look at previous times we've got stop signs, you'll notice over here we go sideways, over here we go down, over here we go down a little bit into a flash kind of sell that gives a small correction. Now, it doesn't mean it's going to be the end of the world and it's going to a new low. I don't think the market's suggesting that at this point. And of course, we've been talking about the bullish implications. But we do have the 20 moving average, which is this red line, and the 50 sitting on top of each other right where we've got gap 2, 54.63. Now, when we take a look at the futures and the options, I guess it also starts to make more sense. Here are the one-day options expected move higher and lower expectations. And here is the 2-hour 20 moving average. Probably the best by the dip moving average so far on the way up. If you wanted to get into this rally, this was the one. Of course, it used our 1-2 system. Very nice. Great work. Now, even over the last 24 hours, it's held the damn 20 moving average. We were getting a lower high. We managed to make a higher high, so we managed to keep going through. But you'll see a bit of a slowdown here in the markets. And that's why it's a bit of a cause for concern, but also we need to see this. We need to get all the indicators back into line. The longer it coils, the longer it sits. That's what we call a pit or a pullback in time. That's a good thing for traders and investors. And we do want to see that. Something ballistic that runs off, that never ends well. So 2-hour 20 moving average holding up for now. Some break belows, 55.85, could bring in some short-term bears. And of course, the 2 levels you'd be aiming for specifically would be those gap fills. I think the gap fills make most sense. Daily 20 moving average in particular would be a great zone. So a series of higher highs, the trend is still up. If you're in it long, you don't have a sign of weakness just yet other than some early indications, but we will look for the price action. Of course, that's what we're always doing. Let's take a look at the options flow. First up, these are all the strikes. You will notice there are calls everywhere, which is a huge difference from where we were 2 weeks ago with puts everywhere. And we have a big one that sits around this 56.50 area. Now that's taking into consideration all strikes. Let's take a look closer to where we are right now, 56.30. That is the absolute bull cap here. Now, if we get through that call level, positive gamma, guys, it's going to overflow this market. You can see how important 56.30 is and how it could feed into the end of the week on a 56.50, which then takes the market obviously to all-time highs. Now, this is such an important level here that we need to be looking at it. I think day traders will be specifically focused on 56.30. How does the market react to it? If the market's able to get back under those break low levels, then maybe Wall Street said, you know what, we want to make a bit of money here on these options, but we are still in an overall positive gamma flow, so we must keep that in mind. CTAs missed out big time on this rally as well. You might think that some of you out there maybe missed the rally. Well, CTAs missed it big time. Remember, these so-called experts out there often underperform the market, and CTAs are down on the year. Let that sink in. They're not doing so well. So they were hugely selling off on that VIX 65. They got caught. This was a momentum fund. Oh, wait, we break them down with the algos. And then all of a sudden, they haven't been able to buy back. So they'll be clamoring to buy the dip, along with, of course, these buybacks. This buyback period's open, creating, $5 billion of pretty much equity purchasing a day. It's pretty wild. NASDAQ CTAs also caught well underneath. Copper CTAs improving. We've talked about the metals market turning around here a little bit. It's been good. Silver still improving. Great chart. Love silver the last 2 weeks. Gold CTA is definitely taking a breather, which is totally different to price. So it's a little bit, we need to pay attention to this. They are momentum funds. So if that starts to get wider and more disconnected, we will need to be paying attention to that. It's not great when they do drop positions for a long time, of course. They're not with the buy at this stage. And Brent is up, down, all around. No real easy decisions there. When we move over to Tesla, we know 228, 230 is that resistance. And I'm looking for 232 as a possible buy, kind of take profit zone for people who have been trying to day trade this thing up. We are in positive gamma. We know that above 228 would be pretty ballistic by the end of the week, but this is the key level to be watching. On Nvidia, however, we're right at that res. We know 130 is big res. This is a call wall if ever I've seen one. I do still expect the market to try to hold below 130 for this week. And I think one of the reasons that we're seeing those big dark pool liquidities is a lot of semiconductors have run too heavily, 30+%. Let that sink in. That's wild. 30+% on $1 trillion companies. Wow, that's just absolutely obscene. And that's what's been leading through this market. So it's an absolute massive buy fest. And that's leading into, of course, maybe a little bit of a pullback speculation. Is it still overall net bullish? Yes, the stats are still supporting net bullish, especially into the back or the first kind of half of September. Let's take a look at US 2 versus 10-year. You'll notice here that, of course, we are pulling back a little bit on the yield inversion. Nothing much to report there just yet. Treasuries continue to rise. People are speculating on that September rate cut, trying to get ahead of treasuries. I don't think it's a great trade, but of course, if you are holding treasuries for a longer period, that could be quite interesting. That whole leverage position into the Fed as well, and the decision they make in September, that could create significant volatility and opportunity in treasuries. So we will be watching that over the next month. Stay tuned. Make sure to subscribe, guys. It's getting exciting this year. I think the next 2 years are going to be totally ballistic in markets, both for the bulls and the bears. So if you're a day trader, if you're a swing trader, or just someone that wants to get possibly even the word, I hate using it, generational lows, there could be some significance coming in over the next 2 to 3 years, especially there. Let's take a look at US dollar. It's dropping. This is what we've suspected for a while. Even Stanley Druckenmiller has been, very, very negative on the dollar. This is actually another stage of late cycle investing. If you ever want to find out more about that, it's in our advanced masterclass over at our site, webfxevolution.com. Links in the description. It totally blow your mind. Great reviews. Thank you very much for everyone that has reviewed it. And look at this US dollar. Now, this thing's been running a leg. So you just completed the third leg over the last 24 hours. Now, if you don't know, markets often do move in synergies. So you can see here the synergies of these legs. And the thing that's really cool about it is when you spot it, like we did together, when you spot these particular positions and you think about it, look at those, look at the pullbacks. They're exactly the same size and length. The move is exactly the same size and actually just hit that first target. Now, I think it could even go lower, but if you were in the dollar short trade, congrats. You hit it over the last 24 hours. Well done to you. Pays to know. And once we got under 102, it was very clear that we were moving towards this 180. Can we go lower? I think we're going to parity 100 ultimately, but maybe we've even got a fourth leg in this. So what would you be suspecting? Well, you would mark that out. And then that will come back here, roll reversal, support becomes resistance, 20 moving average will be sitting there, plus some other stuff. I don't know if I'd buy the dollar here, but certainly something to look out for. Copper couldn't make it through the highs, so it's still pretty much in a downward trend on higher timeframes. But as you know, we've been bullish copper for the last week and a bit, and that's forced it into this really good TP zone. We'll keep watching the metals markets. Gold, still strong, just hovering. That's okay. Had a great week last week. Silver, even stronger, did manage to close above this high here, so still very significant. I'm actually looking for a pullback on silver. I'd like to see it pull back, then find strength. Over the next video, we'll really dive into where we think silver could come back to, because I do think that's on the kind of concept of maybe even getting a $34 price target over the next coming months. So exciting stuff. And then we move over to oil. Now, one of the members of our community actually outlined UK oil looking a lot better than US oil. And I agree with that person over the last 24 hours. However, the problem is you're trying to stop a freight train. And the thing is with oil, is it just hasn't given that really strong turnaround. So you'll notice here when we look at it, this thing is politically charged. We are in a US election year. Everyone's focused on how much fuel costs per gallon, etc. in the US. So this is just such a dangerous trade from that aspect. Now, of course, the weekly really wasn't good last week. We're still at that point where buyers could be in, but I think it's net, very, very, I'd almost say, yeah, it looks bearish, but we're at a neutral level for oil at this point. Tesla, still looking towards 232. No real signs of significant weakness just yet. Intel bounced up a little bit, looking for this thing to 23. Yes, it's a terrible stock. Yes, it sucks. But again, the replication of a trade up after seeing accumulation is just all you're doing. You don't need to hold it for a million years or anything. Nvidia, 130. We know that's a res level. Can we break through with such a huge run? I would suspect to see sideways or even a little bit of downward here. So definitely caution on that stock at these prices. And the Chinese stock market has recovered a little bit after that JD news. So, of course, Walmart saying, you know what, we don't want this company anymore, dump that off. And that caused a little bit of negative sentiment after what has been an okay earnings for China. Now, one of the things that also turned out China, I had it as a stat today, I'll just mention it now, they turned negative in population growth. So Japan was obviously one of the big ones that's done that over the last decade, while China has now entered negative population growth. One of the biggest problems with holding long-term Chinese stocks is going to be that issue. Old population, not enough young people. Remember the one-child policy, you cannot rewrite that. We'll talk about that in the future, but that doesn't change my short-term idea here of the next 3, 6, 9 months being bullish for China. Remember, it's a different thing. You've got to talk, that's more of like a decade-long issue over there. US 30, we're still getting those signs of a topping style run here. US 2000, still looking bullish towards 2250, although if the rest of the market pulls back, expect the Russell to struggle. And the Qs keep sitting around the gap fill and the key resistance zone. So not much to go on with the NASDAQ or any of these markets. We know that we have this chance of a pullback, but for now, we just don't have those turnaround signs. And we're using the US 500 as the real catalyst there for it. Now, what about crypto? Well, that was a nice recovery. Closes its first point above the daily 20 moving average here, which is excellent. Obviously, it's found some resistance at the highs, which is going to be some short-term take profits, but it does prove what we said in the live stream on Monday. We drew an arrow at this exact area, 58.77, and look how much you guys nailed this zone. You smashed it. So you knew that this was significant. It continued on up. It hit a first target if you were going to. This is the replication style trade. Now, because it's been coiling for quite some time, if it does breach to the upside, that's very strong. And I've noticed a lot of crypto, a lot of people messaging me saying, Tom, everyone in crypto is so negative on the markets. Well, it doesn't really matter what everyone's doing sentiment-wise. I understand there's a seasonal pattern that's usually negative into September, and then it starts to become very strong. But you've got to look at the price action. Is there a catalyst? Is there some kind of replicable setup on these charts? In this case, there was. Now, the question is, can we get through 62? Because if we get through 62, which the odds are looking better for that now than they were, of course, 24 hours ago, well, that's going to push that idea that we could go to 68,000. And if we get through 68,000, you're talking all-time highs on Bitcoin. So suddenly things are looking a lot better. And if you've been watching this channel for a while, well, I do love the Bitcoin, and I call it the Bit Noodle or whatever you want to call it. One of the things about Bitcoin is that it drives the rest of the crypto market. So Ethereum has obviously been behind that Bitcoin rally of the last 24 hours, and the rest of the market will come with it. They should be higher considering where we are with gold, considering where we are with silver recovery, and of course the semiconductors. So yeah, I definitely think crypto is getting a little bit of suppression at this point. If you're looking for the news ahead, do remember that we have Thursday flash manufacturing PMI. We've got Fed Chair Powell speaking and annoying us all on Friday, so that's going to be fun at 10 a.m. And as always, if you want to follow along and follow us with more posts, remember to check us out on X. Definitely check out our website as well if you're interested in any of our courses. And in particular, if you want to know more about cyclical investing and how to use data, PA, and everything else together, check out our advanced course. I think you will very much enjoy it. Thanks so much, guys. We'll see you in the next one. Bye for now. Let's see what Jerome Powell has to say for the end of the week.